Oh, we'll start, right? Okay. So, good afternoon, everyone. Today, I will cover this area of classification of treasury portfolios. Now, we will be categorizing uh, investments into different portfolios, and there are a few classifications that we have to, adhere to. These classifications are not ours, but these are some standards that are implemented in maybe worldwide implementations. We also have adapted same here, and we need to adhere to those classifications. First, we will see. Now this is like, you can call it investment management or portfolio management. Now here, now in banks we deal, or even other financial organizations deal with a lot of instruments, a lot of financial instruments. All this time, actually, we have been going through some of them, and also we have been doing some calculations to ascertain the income and the prices of them, and also the interest portions, like that. So we know, we are familiar with most of the instruments, and as a matter of, like, as since you are in that, you are also in the same business sphere, what are the instruments the banks will deal with. So we will first see what is a portfolio. Now, I know it's a very common and well-known thing, but if you recap what we have learned over years by experience, portfolio is a bunch of investments of the same category, like same type securities. When you have uh, many securities of same type, then you call it a portfolio. So now, if you have bonds, you have so many bonds in your investments, then you call it as the bond portfolio. You call it as the bond portfolio, right? So now, likewise, you have different types of portfolio. So portfolio management is, now I have given here some definition, a book definition. Portfolio management is the process of selecting the type and mix of investments, right? Such as bonds, shares, debentures, to achieve a specific investment goal. So the banks and financial institutions, they have specific goals, right? In terms of maybe credit, advances, deposits, and maybe profit. And you call them sometimes, when you give these to the branches and the individual level, you call it key performance indicators. So like that, they have some specific goals for investments as well, right? What is the investment that we are going to have in uh, we are going to have in maybe next 5 years? What is our plan for that? Is there a specific need that we think of in terms of investments, right? So now, we for that, we need to select some type of investment. No, we need to select. So and then we have to have the correct mix of them. uh, in our, in our intention, like in the sense in our specific goal, in line with our specific goal. So for an example, now it's not like that you go to the market and you buy uh, you buy these investments, or you put money in these instruments, or you invest in this instrument ad hoc basis. It's not like that. That is, now sometimes someone will say, okay, now share market is doing well, so you don't, like, these prudent portfolio manager would not, just jump and buy those shares. It will give sometimes a good return. You can see that it, you can see the facts, and the facts and the figures of that statement, saying that the share market is doing well. But a prudent manager will not deviate from their investment goals. So they have set goals for investments, so they are very specific. So you try to be in line with those all the time, right? Because you have a plan. You have a plan. Now this plan, this goal is not ad hoc thing. You have researched a lot of things, and then you have come to this decision. You have come to this decision of uh, having what type of instruments that you will have, and in what mix, right? In what mix, in the sense, okay, we will say we have bonds, shares, and debentures. So we decided to go for bonds, shares, and debentures, or bonds and shares. So we will say the mix, bonds. Now you have a value. I mean, you have some fund which you will be using for these investments. We will say that the value of the fund is, maybe it can, it can change over a period of time, but right now say it is 100 million. So you will say, okay, out of this 60% we will be putting in bonds, right? 10% only in shares and debentures. The rest, like rest 30%, we will have in debentures, right? We will invest in debenture issues, like that. So you have this type and the mix of investments according to the expert research advice that you get. And also the investment managers view, and their research also would contribute towards this. And also there are certain bodies in a bank, like the risk committees, a certain liability management committee, those kind of committees have a lot of experts involvement in those, right? So expertise ideas will come through those those uh, committees. So it can be a risk committee, it can be a ALCO, like asset and liability committee. So likewise, so then they will decide all together. They will decide considering the market, uh, market behavior now, and what behavior of markets that you expect in future, what behaviors of markets that you expect in future. So depending on all these things, considering all these things, that build up your portfolio. You just don't go and buy, and you just ad hoc basis, you don't go and buy and try to build up your portfolio. You have a plan to do that. Goal, actually, you have to, you need to achieve this during a specified period. So it can be like, may not be 1 or 2 years, but it can be going further, and one can say, okay, next 5 years our goal is this. So then now you all know, like, although this has although we have a plan, like, or everyone has plans in their investments, and especially organizations, they have, like, as I explained now, so they have their investment plans. So then but only thing, the market volatility is a major factor in deciding this, or rather, once you decided, then later on, the market volatility or market changes. Now in 2020, like, we now, although this pandemic started in 2019, until 2020 March, we were very comfortable, right? We were very comfortable. We were having all these activities also, and the financial sector also didn't have that much of preparedness for this, right? All of a sudden, by maybe just after mid March, when when we had the curfew for a few days, only everyone realized that we are facing a pandemic which will have a huge impact on the financial sector as well. So then, in a case like this, what will happen? We will not be able to achieve what we wanted. We will not be able to achieve what we wanted, because the market conditions have changed. Market conditions have changed. So now you try to the portfolio management is that, actually you have a specific investment goal, then you further monitor and adjusting those investments, right? Okay, over time, depending on market conditions. So depending on market conditions, you try to adjust here and there, like, that also you will have a plan. You will have discussions in various forums, ALCO, risk committees, like that. And so they will give their expertise ideas, or rather they will go through the researchers reports, and they will check with the regulator, like that. They will try to adjust their investments over a period of time, over time, depending on the market conditions, to achieve optimum return, right? So they want to achieve optimum return. So that is the subject of portfolio management, right? So I hope that you understood how banks and other financial institutions set up their investment goals, and then time to time adjust. Anyone would do like that. Not even need not be a financial organization, even a trading organization would do. But this is very important in a financial organization, because not like in a trading organization. Now they deal in commodities, and these commodities have more or less consistent prices over a period of time. There can be inflation and other various factors coming into the coming into play. But only thing, this the financial instruments value is values are they are the variation, or the change is very rapid. So, like, you overnight you can see the price movements, right? Price movements overnight, you can see the price movements, right? So so it is very important for a portfolio manager to look at this his investments and his and the market conditions very closely. He has to monitor it, day in, day out, like, and then, try to achieve the optimum return. We will see how, what type of things, what type of portfolios and their classifications in coming slides, right? A portfolio, again, I have given another, another definition here. A portfolio is a collection of financial investments like stocks, bonds, commodities, cash, and cash equivalents. So we went through this area a while ago, and and as I said, similar type of instruments pooled together, right? That is what it says, collection of financial investments. So now you have a huge one big portfolio. Now a bank will have a one investment portfolio, entire portfolio, right? So that consists of bonds, shares, other commodities, cash and cash equivalents, all these things, right? So that is one full investment portfolio, right? But within that portfolio, you get specific portfolios, like, you get, now you have investment portfolio in general, and you have bond portfolio in that, and you have share portfolio, you have a debenture portfolio, you have other commodities, like, commercial paper, like that portfolio. Now you can have derivatives even. Now I haven't mentioned derivatives here. In Sri Lankan market, we don't have derivatives except for some stock transactions. So likewise, the collection of financial investments is called a portfolio. Just give me a minute. Hello. So why this categorization of portfolios are important? Why this is important? To identify the real requirement and exposure. To identify the real requirement. Now, as I earlier mentioned, now you have a investment plan, no? So that is your requirement. So, and once you invested, you have to now what is this categorization? You categorize portfolios by nature of the, by the instrument, the bond, the shares, like that. So why it is really important? Because you need to see whether your real requirement is met, and also whether whether you are exposed enough, or whether you are less exposed, or you are overexposed to these instruments, right? So that is one aspect of this. And the other one is the control trading activities. So then, depending on the market, now your portfolios. Now you have one portfolio of 10 billion. You have share portfolio of 2 billion, like that. You have a treasury bill portfolio, treasury bond portfolio. So now you can control your activities accordingly. Now you can control your activities accordingly, right? So that is one aspect why this categorization is important. Why, when we say the categories. Just give me a minute. Hello. මං හදිස්සියක් ඇයි මේ දිගින් දිගට කෝල් කරන්නේ මොකක් හරි හදිස්සියක්ද Oh, Gilen, Russian, okay. Sorry. So to control these trading activities, right? And now we have certain standards, that is worldwide standards we have. And we have regulations imposed by our regulator, right? And we have laws governing certain areas of these investments, right? So now all these investments are governed by various laws, right? Now if you take treasury bills, it's a treasury bill ordinance, right? And when there's a change, the government will pass enact those and pass in the parliament those changes. So they become a law. Regulations are the directions issued by the central bank. So central bank has power by law. Central bank has power to issue and manage, issue directions, regulate, put all these banks and financial sector with under their regulations, and also to monitor it. So that those are the regulations. There can be other authorities as well who we have to check when we do transaction, like Colombo Stock Exchange. Now Colombo Stock Exchange has these securities commission, right? So they are the people who are issuing regulations with regard to shares and stocks, right? So likewise, there are so many regulatory bodies are there who are issuing directions and make them a regulation, right? Make the content the regulation. And standards are there. Now mostly the Sri Lankan standards are actually based on the world standards. Why we need to achieve standards? Because then only we will get the recognition from the other countries. So standards are we have this risk management Basel II and Basel III standard, and we have these accounting standards. This is the standard actually most importantly affect us, and also the risk, certainly the risk one, the Basel III. So and they are actually, so our transactions, when we categorize into different portfolios, the transaction, now I'm talking about the different types of portfolios, right? So when we categorize them into different types of portfolios, we can see whether we are abide by the standards, world standards, whether we are adhering to the regulations and laws. So it is our process, or our work become very easy to monitor them. Otherwise you have to, now if you have here and there in one whole lot, right, without any categorization, right, then all will come under one investment category. So then it will be difficult for you to apply different standards, apply for different instruments, right? So that's why categorization again is an important area in portfolio management. And these are covered by investment policy of the institution. Now all the banks and financial institutions, they have investment policies. This is an internal document. This is an internal document based on our investment appetite. I would say, like, investment appetite is what do you want to do, like what do you think, right? Now when you take this financial sector in Sri Lanka, they can have, now we have banks and financial institutions and other various corporates joining that community, like even the money brokers for that this thing, like for even the money brokers will join this community. So now they are actually they will have different views on market, right? They will have different views on market. There can be slight change, slightly different views, and there can be totally different views about the market, right? So these will bring them profits and losses, gains and losses for them. So depending on their view, so everyone would like to have the optimum return, that is the maximum return you can get from an investment. But depending on your approach, it can change, right? It can change. Now I will take some bold example here. This is this is up to a certain extent this is correct. Now if you commercial banks operating in Sri Lanka, so they have different they have different profits, no? They have different profits. If you take first 10, sometimes the first and the last one, between first and the last one, there's a huge gap, maybe some 10 billion rupees, right? 10 billion, it can be 10 billion. So there are other reasons which are contributing to this other than this investment policy. But investment policy also plays a major role in this, right? So that is why I said up to a certain extent this is correct, because a major portion may be due to investment policy issues. So but only thing, all these categorization are covered by an investment policy, right? This is a regulatory requirement. Actually, you should have an investment policy. This is a regulatory requirement. Regulator will come, the bank supervision will check whether the banks have an investment policy. So this policy will say, now in brief, this will say what instruments that you will invest, and what sort of mix that you will have. Maybe you can say 10% in some instrument, and 20%, 30%, like that. The mix is there. Mix will be defined here. So then now debt or equity securities. If you have debt or equity, what is debt? Security bonds are debt securities. Equity securities are shares, right? Debt securities are bonds, debentures, all these things. Most of the instruments we have are debt securities. Now here I am not talking about the liabilities to and the assets in the sense of fixed deposits and fixed deposits, savings accounts, current accounts, and the loans we give, right? My focus is only on the treasury related products, right? So now this debt and equity securities, equity are the shares, right? Shares, mostly the shares. And if you have other investments outside, there are shares also. You get the listed shares and non-listed shares. So any share, any equity can be taken here, must be classified as held to maturity, held for trading, or available for sale. So this is a classification that we need to adhere, right? So this I will be explaining in few Hi, sorry, actually my computer got stuck. We will quickly go to the presentation. We were, we were here, right? Now I was explaining this. I was explaining the about how to maintain the correct mix. Now, what I was telling was uh, now you have a main big investment portfolio, right? Under that, you will have government security portfolio. You have share portfolio, debenture portfolio. Likewise, you will have so many portfolios under the main investment portfolio. So there are now, if you go further down, right, you can drill down further. So you will have treasury bill portfolio, bond portfolio under government securities, right? So then now under bill portfolio, you will have 91, 182, 364-day bills, right? So what bill you would select, right? And in the bond portfolio, you will have 2, 3, 4, 5, 10, like that, years, right? Years of sorry, maturing in that much of years. The bonds maturing in the 1 year, 2 year, 3 year, 5 years, 10 year, like that, or 25 years. So what is the mix that you would like to, like to have? You would like to have. Most of the banks now actually maybe many banks sort now, like they change their portfolios to maybe uh, short-term ones, like the treasury bill portfolios. Because of this pandemic situation, the interest rates have come down, so they think it's not, it's not uh, prudent to invest in uh, long term. But there can be different views, as well, right? So now, as I said, now this changed the entire thing, no? Now this type of situation. So you had the investment, idea, the plan first, the goal of the investment goal. But now you had to change, you have to, go to a different plan. So likewise, now different people will have different mix in these portfolios. So that is your expertise, your market, the experience, and all these things will come into play when when you select the correct mix. So the next point is diversification. Now, by doing this, categorization, you by dividing your investment portfolio into different categories, you are diversifying. You are diversifying your money, right? You are diversifying your money. This is a risk management, tool to diversify. Now, in day-to-day common saying is that they say don't put all eggs in one basket. So that means don't put your cash in one instrument, right? Don't put everything in one investment, right? So sometimes it can be very attractive. This investment will give you attractive returns. Now, for sometimes when share market is doing well and very active, people think everything that people think of putting everything there in the share market, right? So they will try to try to sometimes bring a lot of money by selling other assets and put in share market. But you have to go by your investment plan, investment goal, and you have to think of your mix, because diversification is really necessary when you are managing your portfolios. So categorization will, you know, give you chance to diversify. So this will, because the why diversification is good, because diversification, when you know, like, okay, even within the portfolios you can diversify, like within treasury bill portfolio you can diversify 3 months, 6 months, and you know, 12 months. And within share portfolio you can diversify. Okay, hotel sector, agriculture, banks, sorry, yeah, hotel sector, agriculture, banks, trading, or like that, you have to, you know, you have to diversify your share portfolio. Within the portfolio also you can diversify. Now say, suppose if when hotels were doing well, if you had put all money into hotel industry, right? So you can now see now, no, like with the situation, with the tourism has come down to zero, that hotels are not, you know, earning. So likewise, so if you diversify, then if some sector is not doing well, other sector will do, right? Other sector will give you income to cover your, you know, cover your requirements. So likewise, so diversification is one of the major things in portfolio management. So we will move on to see how these treasury, what are the treasury related investment portfolios. Now when I say investment, this is in terms of investing money, right? Investing money, not the investment portfolio as in a classification, right? This is when you invest. What are the investment? Treasury investment. What are the treasury investment usually you find, right? Now in people who are dealing in treasuries will have definitely have this government securities portfolio. So they have bonds, bills, repo, reverse repo portfolios, Sri Lanka development bonds. Just a minute. Hello, hello. මම අද ගෙදරනේ චම්පිකා අද නිමාඩු. Yeah, I නෑ චම්පිකා අද මම ඇත්තටම මේ නිමාඩු ඉන්නේ මේ මම වෙන වැඩක නිමාඩුවක මට පොඩි උදේ වෙන ප්‍රශ්නයක් ඇති වුණා ඒක නිසා මේ ඔව් 2 days චම්පිකා ගන්න හිටියේ නම් හරියට මම ඒක කමියුනිකේට් කරන්න නැතුව ඇති ඒකයි ඔව් ඔව් මොකද චම්පිකා කරන්න ඕනේ ඔව් අපේ එක මං හිතන්නේ අපි ඇරියා මම මේ අසංක කළා ඊට පස්සේ මම බලලා ඇරියා අනිත් ඒවා ඔව් අනිත් ඒවා අපි දැම්මා අනිත් අයට රෙස්පොන්ඩ් කරන්න කියලා ඒගොල්ලන්ගේ රෙස්පොන්සර්ස් තාම මං හිතන්නේ ආවේ නෑ චම්පිකා ඒකයි ප්‍රශ්නේ උනේ ඔව් මං ඕනේ ඒක මං හිතන්නේ අපේ එක ඇරියා චම්පිකා ඒක මේ ඔව් වෙනම ඇරියා අපි අසංක ඇරියේ ඔව් ඔව් දැන් නෑ චම්පිකා ඒක වීක්ලි තමයි කරන්නේ දැන් අපි මේ මැනුවල් ප්‍රොසෙස් එකක් ඒකට ඉම්ප්ලිමන්ට් කරනවා ඒක ඇත්තටම ඩේලි කරන්න ඔව් ඔව් මම බැලුවා මම ඒක චෙක් කරන්නම් ආයි චෙක් කරලා මේ බලන්න මොකද දැනට ඩේලි කරන්නේ නැහැ ඒක අපි process එකට manual process එකකට යන්න හදන්නේ දැන් ඇත්තටම. නෑ ඇත්තටම අපි right. Then to be clear. අපි ඇත්ත 1st of July June තමයි යන්න හිටියේ. අපිට ඒක කරගන්න බැරි වුණා. මොකද අර මැනුවලි අපිට අර අපි දෙන්නේ ගන්න හිටියානේ අර මේ ඉන්ටර්න්ස්ලා. අපිට අර ඒ ස්ටාෆ් ප්‍රශ්න නිසා තමයි යන්න බැරි වුණේ ඇත්තටම. ඒක මොකද Yeah, I'll be coming there. Where ප්‍රශ්නයක් තියෙනවා. Right. හරි ජම්පියා. අද රැයටම කරන්න හවසටම මට right. හරි ජම්පියා. Right, okay. I'll check that. Sorry for the interruption. I got a bit urgent call from the office. So every institution, the financial, especially the banks, they will have a government security portfolio. They'll have a government security portfolio consists of bonds, bills, reverse repo, SLDBs, and ISBs. And apart from that, they will have equity portfolios and foreign exchange investments will be there, right? And then debenture portfolio, they will have trust receipts. They can, categorize this under other debenture, trust receipts and commercial paper. They can, sometimes can categorize in one portfolio. Or they can have separate portfolios for debenture, trust receipts, asset securitization is the, the basis of these trust receipts. And then some banks will have corporate bonds, but only thing in Sri Lanka, you don't find corporate bonds like, some debentures were categorized under corporate bonds, and commercial paper is there. And sometimes some banks do invest in global bonds as well, but now these days I don't think anyone would do this. And even when some banks were doing, they were at a very very minimum level, right? So these are the portfolios a bank will generally have. There can be other portfolios like if I have not what I have not mentioned here is one main one is the gold portfolio. Some banks are into gold trading, like there are certain rules and regulations for this. Within that, they do sometimes gold trading, but only thing these certain things like the equity portfolios, gold and global bonds kind of, and commercial paper, they are not that that popular, because time to time with the market movements and level of participants in these markets, that you can't have active trading in bonds and bills like now, like in bonds and bill markets, right? So especially the government security market is now when you take out of all these, FX is a separate area, foreign exchange is a separate area, but when you take out of all these, the mainly an institution will have mainly, right, government securities portfolio. Mainly an institution will have government securities portfolio, right? So in that you will get bonds, bills, repos, reverse repos, and SLDB. So the concentration is on government securities. Other things are there. FX is a separate thing, but other things are there in very minimum level. Now equities, some banks were into equities a lot, but then most of the banks actually they came out of equity portfolios because this is a bit of a stagnated area right now, and also time to time it gets activated, but then your money will get stuck here. Now even the government security market is sometimes become dull. Still, that it's a very very live market, live market, right? Although sometimes the activities go down, it's a very live market, and this is related to our business, right? This is related to our business, as well as the the regulator is handling these, like now the bonds, bills, and all these things are coming under the purview of the regulator. But if you take the equity is the monitoring part only coming under central bank, like in the sense like when they want to check. But otherwise it's a different regulator for the equities, like the Securities Exchange Commission is a separate one, Colombo Stock Exchange, right? So so we will move on to the portfolio classification. Now we have different categories of portfolios, right? Under that, we learned that debt and equity securities should be classified according to held to maturity, available for sale, and held for trading. Now these three categories, now any debt instrument, right? Any debt instrument or equity instrument should be classified according to this, right? Should be classified according to this. Time to time, maybe if you take last 20 years, there had been instances this classification was changed time to time, right? I can remember at the inception when I about say 20 years back, like in 2002, like Mr. Ratnayaka also would remember, then we had trading and investment portfolio, like maybe two portfolios, trading and investment, very broad categories. But time to time there had been different standards came in. There had been different standards applied, and then it was changed to held to maturity, available for sale, and held for trading, HTM, AFS, HFT. But right now these are very very commonly used terms: held to maturity, available for sale, and held for trading. But under new classification, now we called held to maturity as amortized cost portfolio, amortized cost, and available for sale one, fair value through OCI, and held for trading one is called fair value through PNL, So we will go through these portfolios. I just want to give you the classification names, right then and right now. But still, for all, certain people still call this held to maturity HTM, or we don't call sometimes amortized cost, but the real term is amortized cost. Available for sale is AFS. Now it's called fair value through OCI portfolio, and held for trading, HFT, fair value through PNL. Now the earlier categorization given you different categories of portfolios, right? And this is a classification. So one portfolio can be classified in these classification, right? Bill portfolio can be classified in these classification again, right? So held to maturity, available for sale, held for trading. 3 categories of classification. So bill portfolio can be classified like this: held to maturity, available for sale, and held for trading, right? And share portfolio can classify under this: held to maturity, available for sale, and held for trading. Now we will go through each and every classification and see what sort of explanation it gives, right? So this is under SLFRS 9. Now what is SLFR 9? This is
Mangala, small question. Can you explain what is OCI is?
Yeah, OCI is this is under equity. This is I'm going there, Mr. Ratnaka. Now when you say other comprehensive income, OCI is other comprehensive income. This is categorizing now fair value through OCI means when we fair value this, it goes and affect the balance sheet. Actually, it's a line in balance sheet, other comprehensive income. Now the held for trading HFT fair value through PNL. So here when you fair value, it goes to the PNL. So that is the difference between fair value through OCI and fair value through PNL. The OCI is a line item in the balance sheet. Other comprehensive income. Other comprehensive income. It's a so say suppose if you make a loss in fair value is actually sorry, fair value is actually mark to market, right? You mark to market this AFS portfolio, and if there's a gain or a loss, this will go and hit the balance sheet, right? But if you mark to market the held for trading, it will go and hit the P&L. So that is the difference. So OCI, for answer your question, OCI is a line item in the balance sheet which indicates other comprehensive income. Hope this clarifies your question, Mr.
Thank you. Thank you.
Yes, right. So so this SLFRS is now you know IFRS is International Financial Reporting Standards, IFRS. So IFRS is a body. They a committee. They publish time to time the standards, reporting standards. Actually, reporting and in fact these are actually when you report your financials, you can have any calculation method and anything in your organizations, but when you are reporting these, you have to report in these standards. So SLFRS 9 is the same as IFRS 9. So IFRS international standards we have taken here. In fact, this Chartered Institute and other various bodies only they go through these, and the legal aspects were checked and all these things were checked, and actually those rules were like adapted here to suit our maybe they have done few changes to suit our the markets, but the core is the same, like IFRS 9 and the SLFRS 9. So this is called Sri Lanka Financial Reporting Standard. So when you report your financials, you have to report in the manner that these standards require, right? So what I actually taken from SLFRS 9. That is why it's a bit crowded. I will anyway go through this. Now, amortized cost. Now, amortized cost is a portfolio. Now, it's a HTM portfolio, held to maturity portfolio. Now, we called it amortized cost, right? Held to maturity portfolio. Now, under this SLFRS 9, we call it amortized cost. Now, what business model qualifies for amortized cost, right? Financial assets at amortized cost are held in a business model whose objective is to hold assets in order to collect contractual cash flows, right? So it says these assets were there with the investor, and the investor's intention is to collect contractual cash flows. Other business models, any financial assets that are not held in one or two business models mentioned above are measured at fair value through profit or loss. So any other models, there are one of the two business models. Now, not what we have explained earlier, are fair value through profit and loss, and as such, fair value through profit and loss represents the residual category. Financial assets that are held for trading and those managed at a fair value basis are also included, right, in this. So now by don't bother about all these. Now only thing you have to remember here is what you can classify under amortized cost is the assets you hold with the objective of collecting its contractual cash flows, right? So that means you keep it till maturity, right? You keep it till maturity. So it's like held to maturity. It's like held to maturity. The amortized cost one is like held to maturity, right? So we will go to the next one then. Amortized cost. Held to maturity securities purchased with the intent and liability to hold the final maturity, carried at historical cost. That is what amortized means. Historical cost on the balance sheet. Unrealized gains and losses have no impact on the income statement. So unrealized ones have no income on the no impact on the income statement. So there's no mark to market income or loss here, right? There's no mark to market. Now you can mark to market your HTM portfolio or this amortized cost portfolio. Both are the same. So you can mark to market them, but then what happened was, what will happen is you don't report this mark to market, right? You don't report it as a loss or a gain, because no point in no point in reporting it, because you keep it till the maturity. You keep it till the maturity, because on maturity anyway you will be getting, at maturity you will be getting what? You will be getting the, what do you get? You get the face value, right? You get the face value. So there's no, there's no, like, you record it for the face value, and there's no, reduction in value. What you expect you will be getting. So so the entire face value you get as an inflow at the maturity. So whether you mark to mark it or not, it's immaterial. But for your, if you are, if you have some, some interest in doing that tenancy, you can do it, but no need of reporting it. So unrealized gains and losses have no impact on the income statement. Now earlier, we went to check the fair value through OCI and fair value through P&L. Now, held for trading is that fair value for P&L is the held for trading portfolio. Actually, we now call fair value through P&L. And AFS portfolio, available for sale portfolio, we call fair value through OCI, right? You got my point, right? So then, now those are actually, those are under IFRS or SLFRS reporting. You need to report them. That is why we say fair value through OCI. So if there's a loss, right, in this, what is fair value? Fair value is mark to market, no? Marking to market, right? You mark to market your portfolio using the market rates. No, now if you sell, now say suppose if you sell, you get a price, no? You get a price. That price is calculated at the market price, right? Sorry, market yield. So you use the market yield, and then there are various methods how you obtain the market yield, right? So you can do by using usually we do by using two-way quotes of central bank, right? Two-way quotes of central bank. Now I am talking about a bond and bill portfolio, right? So for that you can use the two-way quote. If you are marking to market the equity portfolio, then you have this the closing prices of share trading each day. So for that you can mark to market, right? Then repo and reverse repo portfolios you need to mark to market, right? So likewise you mark to market them and see whether there's a plus or a minus. So if there's a plus, it's a gain. Minus means you have a loss. So now under AFS portfolio, which is fair value through OCI, this will be charged to the OCI, that is other comprehensive income in the balance sheet, right? So but trading portfolio, if there's a mark to market loss or a gain, this will go to the P&L directly as an expense or an income. You will say gain on mark to market and loss on mark to market, likewise, right? Gain on mark to market and loss on mark to market. So there will be gain or a loss. So but here you need not worry about it, because it is not necessary. Now this is arguable. Now these are standards, but we have to adhere to these. But this fair value through, now if you take for an instance fair value through P&L, right? Fair value through P&L, if you take now, you don't sell the security, but you have to check the value according to the market rate, and then if there's a loss you have to record, right? Say suppose some company, they have a huge portfolio, they don't intend to sell, right? They will think, since the market since the value has come down, right? If the value, now say suppose now we have a portfolio, and if the market rates go up, right? We have a portfolio, and if the market rates go up, what will happen? If the market rates go up, what will happen? We will be losing on our portfolio, no? Mark to market loss, right? Mark to market loss. Say if the rates go up, and then the prices come down, and then we suffer a loss, right? Then if we suffer a loss, then we have to record that in the P&L, right? So according to these standards, according to these accounting standards, we need to record that in the P&L. But this P&L only the people will look at, no? People will look at that and see the losses that you have recorded. Sometimes the entire P&L can go into negative, right? In the sense, say if you have a huge mark to market loss, right, you will not have any profit for that day, that month or that year, right? But you have not realized this. You understand what I say? You have not realized this, but you have to report like that, because your report only the outsiders will see. Your report only the stock exchange will file in their if your company is listed. Now banks are listed companies in Sri Lanka, so your P&L you report will only be published in stock exchange. So then people will see you have recorded a loss this year. So this has a bad impact on the companies, right? In 2006 to 9, like they have suffered a recession in US, right? Recession in US. So then most of these companies had to then also these were there, like it was, it was then HTM, AFS, and trading, HFT held for trading. So then most of these companies had to record this loss. Those were mark-to-market losses. Those were mark-to-market losses, but they had to show them in the P&L, right? So their P&Ls were very bad then, right? Then that actually led the way for investor confidence, losing investor confidence, right? So they lost investor confidence, and companies went into insolvency. That is, they bankrupted. So so they went into insolvency. So in that sense, there had been arguments between these investment managers and the accountants, right? So accountants and now investment managers were arguing that we have some investments, and they have come down in value. That's true, but when we record that, it shows a loss, but we have not realized this loss, right? We have not realized this loss. So this leads to bankruptcy, right? This leads to bankruptcy, and this is bad. So it's accounting. But then the accountants argue, now since you have selected a bad portfolio, only you have to suffer that. So you can't avoid reporting this, right? So you can't avoid reporting this. If you had selected good portfolios, good investments, then you wouldn't have had this issue. You wouldn't have had this issue. So because of that, you have to record it. So there it's standard is you have to record this. Standard is you have to record this. You can't avoid recording this and enjoy your profit, right? So if there's a profit, even you can show it as a profit. So the good side of this is, if you have profit, if your portfolios grow in value due to market rates movements, right? So that is, if the market rates come down, your portfolios will grow in value, right? So there, HTM, there's no relevance, but other two portfolios, you can take that amount into consideration and charge in other comprehensive income and also in the P&L. Now when I say other comprehensive income, it's not a P&L item. In organizations we have balance sheet. No, balance sheet, that is a position, statement of financial position. So the balance sheet and the profit and loss account, right? So now profit and loss, now if you have a fair value through comprehensive income, it will go to the balance sheet. It will add to the balance sheet, right? And if you have fair value through trading, fair value through P&L, then it will add to the profit and loss. So you will have a mark to market profit, mark to market income for the appreciation of the portfolio. For the appreciation of the portfolio, you will have a mark to market income. So now if we go through this, like this I explained, but I will go through the slide. What business model qualifies for fair value through other comprehensive income? So what qualifies here? Financial assets classified and measured at fair value through other comprehensive income are held in a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. Now here, earlier occasion, amortized cost, we didn't have selling financial assets part. It was only collecting contractual cash flows. It was about only collecting contractual cash flows, right? But here you get the selling. So you can, if you need, right? Okay, you have both collecting contractual cash flows as well as, if you want, you can sell the asset as well, right? Sell the asset as well. So this is another type, and we will do this and stop for today. I think it's fine, but sorry for the interruptions. We had two interruptions which took maybe about 10 minutes of your time. I will try to we will anyway, we will be covering the course material, no? So sorry for it again. The other business model, now fair value through P&L. This is called this is earlier called held for trading. So you held these for trading activities, right? So any financial assets that are not held in one of the two business models mentioned above, that is the earlier ones, are measured at fair value through profit and loss, right? So which were not there in earlier, they say, which doesn't fall into that, those two categories are fair value through P&L. As such, fair value through profit or loss represents a residual category. So that means it's a it's a residual category. If you can't fit them into others, you fit here. But anyway, we have an explanation for that. Financial assets that are held for trading, right, and managed on fair value basis are also included. So that is held for trading, right? Anything which are not fitting into those categories, and mainly held for trading. It doesn't say to collect contractual cash flows, right? You will be collecting, but the intention is not that. Intention is not to have it till maturity, right? It is, the intention is to trade. Intention is to trade, and they have to go through the fair value process. Intention is to trade, and they have to go through fair value process. So those are the ones which are called fair value through profit and loss, right? So hope that you understood three classifications. These three classifications are very important because we have to have the financial institutions abide by the the rules attached, or the regulations attached, or the standards attached to these three types, right? Once you decide, right, this is the, once you decide on an investment, you will select one of these categories, and then you place them in these categories, right? So in the bank, if I tell you, in the bank we have these three portfolios, right? So that is when you buy, now there will be, you can take separate reports. Okay, if you want to get amortized cost portfolio, it is separated. And if you want to get AFS portfolio, that is fair value through OCI, it is separated, right? Then if you want to get fair value through P&L, that is a trading portfolio, it is separated. So there's no mix up in securities, and you can't there are ways, I will be explaining them, how to how to do portfolio transfers, and how to sell from how to sell from the HTM portfolio. But these three categories are having three separate accounting treatment, right? Treatments, three separate ways of treatment is there for these three categories. So So we will go through how we will be treating them in our next class, and then we will understand how important they are, right? So thanks for participating in the class today. I had two unforeseen interruptions. Sorry for it, and have a nice day, rest of the day. Good night.
Thank you, Mangala. Thank you.
Yes.
And next is next Tuesday, 13th.
Yes.
How many more slides are on this presentation, Mangala?
This has about only, this is a small one. This has about now we are on the 12th, 11th. No, we have about 6 more, 6 to 7 more. Yeah, 6 more slides.
Right. And with that, the presentation that I sent you can also be covered.
Yeah, we can do both actually. We can do this about these practices of different practices.
Yes.
In trading.
Yes.
Trading activities as well as this. So we will cover that on Tuesday.
Right. Thank you, Mangala. Thank you.